They get taught about something called the money multiplier. The money multiplier story says that banks actually create much of the money in the economy. Here's how the story goes. A man walks into a bank and deposits his salary of £1,000 in cash. Now, the bank knows that on average, the customer won't need the whole of his £1,000 returned all at once. He's probably going to spend a little bit of his salary each day over the course of the month. So the bank assumes that much of the money deposited is idle or spare and won't be needed on any particular day. It keeps back a small reserve of, say, 10% of the money deposited with it, in this case £100, and lends out the other £900 to somebody who needs a loan. So the borrower takes this £900 and spends it at a local car dealer. The local car dealer doesn't want to keep that much cash in its office, so it takes the money back to another bank. Now the bank again realises that it can use the bulk of the money to make another loan. It keeps back 10%, £90, and lends out the other £810 to make another loan. Whoever borrows the £810 spends it, and it comes back to one of the banks again. Whichever bank receives it then keeps back 10%, i.e. £81, and makes a new loan of £729. This process of relending continues, with the same money being lent over and over again, but with 10% of the money being put in the reserve every time. Note that every one of the customers who paid money into the bank still thinks that their money is there in the bank. The numbers on their bank statement confirm that the money is still there. Even though there is still only £1,000 in cash flowing around, the sum total of everyone's bank account balances has been increasing, and so has the total amount of debt. Supposedly, this process continues until after around 200 cycles, almost all of the original money is now in reserves and only a fraction of a penny is being relent. By now, the sum total of all bank accounts adds up to about £10,000. So the multiplier model that is still taught in many universities implies that this repeated process of a bank taking money from a customer, putting a little bit in reserve, and then lending out the rest can create money out of nothing, because the same money is double counted every time it is relent. The model says that if the reserve ratio, that's the percentage of customers' money that the banks have to keep in a reserve, is 10%, then the total amount of money will grow to roughly 10 times the amount of cash in the economy.